my goodness, VXX is $40. What happened? It must have been a huge spike. Oh, wait. No, it's not a spike. The reverse split. Yes, indeed. So today is the first day after the reverse split in VXX, and we inevitably have some people come on and be like, wow, what happened? This is huge spike. But yes, the reverse split did take place, and so look in VXX to see a new series to be listed. You can see when we look at the screen right now. Let's see if I'm in the way here. I'm sort of in the way. If we look at the VXX screen right now, we can see along the option series it says 25 per 100, right? So they've already split. This is reflecting that the split already. These are all the old option series. We should see new option series come online. I'm not sure if they'll come today or maybe at the end of the week, but probably by tomorrow we should have new series on. And I would highly recommend that if you do have positions in VXX, that you consider migrating them to the new options once the new options come on. Now, it's not like you have to do it in the next 10 seconds, but I would do it in the next day or two. I'm just going to go put a sweatshirt on because there's moire. You see that moire on my shirt? That's not good. All right, now we're back on moirade a little bit. Welcome to the program. I just wanted to say hi to everybody. So as it says in the title, yesterday there was an announcement that Biden may be raising taxes to like 41% on rich people, and the market like immediately went down a little bit. Let's take a look at the news story here on Drudge Report, and it says Biden moves to tax the rich. And this is, everybody was grumbling about this yesterday. So let's see. Biden moves to tax the rich. Biden aims at top 0.03% with a bid to tax capital gains like wages. President Biden wants to end preferential U.S. tax treatment of investment income that has benefited the nation's wealthy as he seeks to fund a sweeping new social spending program. But will need to overcome a major political hurdle to do so. So, this isn't set in stone, but definitely the announcement yesterday made the market go a little bit lower. Speaking of things going lower, we've seen a little bit of a sell-off in GME lately, and, it's like, I think it's very hard for me to make friends online these days because every time I post that I'm short GME, I'm attacked from all angles. Like this one this morning said, "You're a moron," blah blah blah. And I think that if I had come on and said the exact same tweet but had put a bullish, if I pressed bullish, then the people would have loved me. It's like any bullish tweet. And you're a star for everyone. Any bearish tweet, and you're part of like the hedge fund boomer establishment. And we found this in the past where people would say, "Oh, it's un-American to be short a stock or this or that." But really recently, it's become a huge thing that you cannot question anything or be short on any of these things, or you're ostracized and you're a persona non grata. Anyway, beyond that, UVXY, I did put a false alarm for the split. It's weird. ProShares came out yesterday with they posted an announcement about splits. and dated it yesterday, and it was talking about a split that was supposed to happen in January. So it was a bit confusing. I've been so eager to like be the first one to announce the split that I jumped the gun and announced the split, and then on Twitter, and then I realized about a minute later that was wrong, and I took it back down quickly. So apologies for that if you saw that and were like, what? Why market maker? No, that's true. I don't. Great question. Great questions, Christina. Why would a market maker worry what StockTwits say? No, I'm not worried. I mean, it doesn't. It's not like it's changing my my strategies or anything by what people say on there. It's just an interesting thing to kind of point out. Hey, what's up, Brent? Nice to see you. I don't know what time zone you're in at the moment, but nice to have you here. If Wall Street was tipped off on the increase, yes, there's conspiracy theories abound about why UVXY did not announce. Well, thank you, Brent, for giving me credit, although I don't think it's deserved. Everybody check out Brent's videos about everything VIX and volatility on his channel. Christina, I would say that, yes, there are conspiracy theories abound about why UVXY has not announced a split yet. Actually, I should say there's only like a very small group of people in the world who actually follow this stuff. So conspiracy theories among us small group of people who follow this stuff. I don't know why they have not released the reverse split info, why they didn't do that sooner. Yes, you could say, well, they they thought volatility was going to pop. However, it's pretty formulaic, right? It gets to a certain, these guys have tons and tons of different ETFs, right? And it gets to a certain number, and it just should be automatic. It's not really a judgment call usually when to reverse split things. It's just like, well, okay, here we go. As soon as it reaches $6 or whatever, it will reverse split. And we've seen that happen so many times before. That's why it's just strange that they don't do it. I don't subscribe to the conspiracy theories. And, the bottom line is, although we love to cover this stuff and talk about it in videos, the split doesn't really matter that much. It shouldn't change your strategies all that much, and it doesn't change how much money we can really make or anything like that. So it's not a huge deal, and there's no real reason to be too strategic about it, I wouldn't think. Now, these guys make money when people buy these ETFs, right? They don't. Those of us who short this with options, we're not putting any money in their pocket. They don't. They're not making a dime off me, UVXY. It's people that what they want is more people to buy UVXY or buy VXX, because the more assets they have under management, i.e., the more people that are actually long the ETP, the more management fees they get. So, we're not really the target audience of these things and of their strategizing anyways. The target audience is people who are long this stuff. In a way, you could say, psychologically, it's more attractive for people to be long this stuff or to buy, VXX or UVXY is more attractive when it's down at the $4 range for buyers, right? Because it seems like it feels cheaper, right? If they reverse split it 10-1 and it goes to, let's say, $45, it seems psychologically, although it's the exact same thing mathematically, it seems psychologically like it's cheaper when it's trading $4. So in a way, maybe they kind of talk more people into buying it at the $4 range, A, and B, if the cost was per share, then they would make more money without reverse splitting it. But I don't know exactly if they actually make more money when it's this way. But there has to be some reason for it. And as I've said before, I did reach out to their investor relations, which is just like one guy who they farm out all that stuff to, and we still haven't heard. I wonder if yesterday that announced the kind of botched way they put stuff up is gonna, foreshadowing things to come as far as the reverse split. But we will have to wait over time and see if that comes to fruition. We don't know at the second, but maybe when we're looking back on this, we will see that actually foreshadowed the reverse split. Now, six-figure investing sort of famously had said that a long time ago that he calculated it would reverse split around July 13th. Let's see if he is correct on that. His article, though, this Vance Hardwood article that I'm reading, does say that he expects it to be a 5-for-1 reverse split, whereas the article that I was referencing yesterday that came out in January has stated that that any splits moving forward will be 10-to-1 in UVXY. So it is expected to be a 10-for-1 split when it does eventually happen. So let's go to GameStop just for a second, just to give you a position update. So the position I have in GameStop right now is out in October, and I'm just long out of the money put spreads, right? So if you go out to October, which is 175 days from now, implied volatility has come in somewhat. It's 133 vol, still high implied volatility, but I am long way out of the money put spread, right? So it's the 60-50 put spread. So if things come back to earth, then my money will come back, essentially, is where we're at with this one. We've seen this kind of, if we look at the chart, it's kind of been doing pretty much what I expected it to do, which is kind of like volumes collapse and slowly moving lower. We'll see if that trend continues or not, but it seems to just be slowly grinding lower. And in a perfect world, we would just kind of roll back down towards 50 at some point slowly. That's kind of where I am in that one. I live in a resort area in Cape Cod here, and A, we're a resort area. B, we're heavily affected by the virus right now. There's a hot spot here, so it's a little scary, but it's kids' vacation week, and thus I am part of the, I have other jobs with the local economy here, which is a tourist economy, and that part of the economy is booming right now because it is kids' vacation week. Thus, you haven't seen me around, but I will be around a lot more coming up soon. Let's take a look quickly at recent news stories in the news to do with volatility and see what we find here. We have obviously seen the VIX move way lower over the last few weeks than was previously. Let's take a look at the VIX chart for a second here, and we can see, if I get out of the way, that we are continuing to trend lower. We reached a low of 15, which is, back to normal, I would say. Now, are we going to have a new normal from now on moving forward? It's possible, but we've been anticipating this move back down again. Now, if we back this chart up even more, we can see this is the range we were in pre-COVID, which is like, 12 to 15, 18 type thing, and we're heading back towards there. Now, volatility, like many other things in the marketplace, can trend. It's a heavily trending thing, and once it starts to trend in a direction, it can continue in that direction. So I would not be thinking about, well, this is time to back up the truck and take a stand at some particular level here. Certainly, it's more attractive down here than it was higher up as far as things go, and it would not be surprising to anybody if we got a little bounce. In fact, we did get a bounce yesterday with the markets being down. We're kind of coming off that bounce now. If we look at a 10-day chart of the VIX, we see we got that low. It looks like kind of looks like an outlier actually. So I wouldn't say I'd say we bounced off 16 more than 1538 because that was just a really brief print. But either way, this is the lowest since pre-COVID, and we could continue to trend lower. Let's look at VIX Central for the term structure, and the term structure has remained fairly constant for the last while. It's been what I would call a healthy, normal term structure for some time now, where we have been in contango and just a nice, smooth, frowny face curve, as you might call it, with contango at decent levels. Currently, we're showing 7%. Contango, we did have expiration recently, and it just looks very healthy. It looks like there's no real fear in the marketplace, and the term structure isn't indicating any sort of continuation of the down we had yesterday. Certainly some sort of raise in taxes was anticipated with the Biden administration pretty much right away. So I don't think that should be news to anybody. Just a small note on options trading. I've noticed that we've been pretty thin as far as the bid-offer spreads. Certainly, the GameStop spread that I traded, the markets were very wide. We can see the bid-ask on the 60 put, 480 at 885. Now, certainly the market's closed right now, but it's been similar markets to these even when the market was open. So be very careful when you are trading option stuff. Just because something is mid-market doesn't mean that that's a fair price, right? You could have one option where like there's one option bid in the book or offered and that changes the mid-market price. So some ways that you could kind of look this over quickly if you don't have a lot of time to be following things. If I queue up a spread here in GME, for example, the spread that I traded yesterday, buying the 60 put and selling the 50 put. Okay, it's going to show the mid-market here at 185. The price 185. We can see if we look at the spread here, actually the bid is actually negative. If you traded on the marks here, you'd actually be buying the spread for a credit. So this is a really wide market. Now, some ways that you can actually check that your pricing is somewhere in line would be if you were to queue up the spread, and if you change the expiration months, right, and you compare what the spread mid-market is in different expiries, that will give you some idea if you're somewhere in line or not, right? Now, these are all pretty wacky. Certainly, this one is a way out of the money put. So if you get pretty close to expiration, the likelihood of this coming in, the stock needs to go down, well over 50% for this to be in the money. So if you're comparing the spreads not very far out in time, the spread's going to be worth a lot less than if it's farther out in time. And it's very difficult to establish an actual delta on a way out of the money option, especially when you've got volatility moving all over the place. And certainly this trade of being long a way out of the money put spread, certainly as volatility comes in, the value of this put spread is going to decrease, right? Because the likelihood of the underlying making a big move is reflected in the volatility number. As the volatility number comes down, the likelihood of that outlying move is by definition coming down. So this is kind of a hard spread to evaluate the value of and to predict the value of moving forward. My thought process on it was, well, I'm betting 1 to make 4, right? So if I pay, it's a $10 spread. If I pay $2.50 for it, then I'm paying a quarter of what it could be worth. and I kind of evaluated it that way. But another way to kind of just check would be to you could look at the call spread, right? So if you look at the bid offer on the call spread, if the put spread's trading, 250, the call spread should be trading somewhere around 750, because they're two sides of the same coin. That's one way of looking at it. Another way of looking at things is if you are on Thinkorswim, you could go ahead and go to your theoretical pricing, right? So I pulled up theoretical pricing here, and I want to look on top here and make sure that the date is correct for this. I reset the date. And a lot of times, this isn't going to be super accurate. Sometimes they're just going to fit the prices kind of in mid-market. But still, it will give you some sort of idea. So if we look at theoretical pricing here, we can see that the price of the spread right here with these theoretical prices is somewhere around $1.85 for 680 minus 497. So I'm sorry, 682 minus 497. So it's somewhere, a little under $2 what the theoretical value is giving for this. And once again, you could go ahead and look at other months to try to compare them to get an idea of kind of the range that you're looking at. So here, if we go out to November, for example, and we look at the theoreticals here, we can see somewhere around 870 minus 590, so $3, somewhere around there. 280, something like that. So as we got in time, it becomes, the value goes up because it gives you more time for this to make that down move. So I would be very careful, though, when you have an illiquid situation like this, trading spreads, because you don't know how much you're going to have to sacrifice to get in and out of this kind of thing. You might be able to get in for decent prices, but getting out could be hard. Another clue as to how liquid things are going to be would be to look at the open interest. So if I go to volume open interest, you can see, all right, well, the options I traded here, it's 175 days out. The 50 put, there's 850 open interest, which, is okay. The 60 put, only 67 open interest. Now, as this gets closer to expiration, more stuff should trade in it. If we look at the calls on the other side, similar. Not a whole lot going on here, so this is a kind of trade that you don't want to be moving in and out of a whole lot, because they are gonna tax you to get in and out of it. So for me, it will work out okay because I'm satisfied with the prices that I put it on for, and I'm just planning on leaving it for a while. But if you are thinking of getting in and out of stuff, choose something that's more liquid than this, right? So we're seeing the VIX down 24 cents as we come into the open here. GME really just volume is really low. Look, only 58,000 shares have traded. We've got a little over 2 minutes till the open, and only 58,000 shares have traded. That's, very, very low. We were seeing, several million trading before the open. In fact, we were seeing between 4 and 5 in the morning, 1 million shares trading at some points. It's pretty remarkable if we have less than 100,000 shares before the open trading in this. Now, low volume does not point specifically to bearish or bullish, but it does make the case that people are not as interested in this as they were at some point. And my strategy is that a lot of these people that bought this are fast money people, and when nothing happens for a while, they're going to bail out. I don't see long-term investors being long this at $150, right? If they didn't like it at $2, a couple months ago, why are they going to like it at $150? But we'll have to wait and see what happens with that trade. I certainly don't, I'm not telling you, anybody, to follow me trading this. What you trade is up to you. Hopefully, I just give you an idea of what one trader does over time. Christina says, how to define that open interest is good? Well, that's a very excellent question, Christina, because It really just depends on the product and what's going on. I mean, if we look at Apple, for example, the open interest is going to be much huger. Or let's look at the SPX, for example, something that's pretty liquid. Open interest is going to be much bigger. Let's take a look here. Look, then I say that there's zero open interest. Let's look at Intel, right? Okay, Intel, October, 4,000 each strike. This is much more liquid, right? Volatility is way lower, 35, but much more liquid. If we look at the front monthly, same thing, much more liquid. So it really, it almost doesn't give you hardly any information, the open interest. The way to establish liquidity is both looking at things like that, but also just trying to trade stuff. Do people, if you try to buy a one lot mid market, does it work? Are people willing to trade with you? And in a sense, you can't get a feeling for these unless you actually do go out there and enter the marketplace and try to buy and sell stuff and see how liquid it is over time. I've been trading GME enough that I have a good sense of how liquid it is just from doing trades, right? You could have a product that doesn't have a whole lot of open interest, but still has, it's just that people aren't interested in trading it that much. However, the market makers are making decent markets, and the markets are relatively tight, and you can get stuff done, but people just aren't that interested in it. You can have things like that. Certainly, GME is in the news. The stock is followed by a lot of people, right? If we look on StockTwits, there's a lot of people following GME. Let's see how many people are following GME as of now. 198,000 people on StockTwits are following GME, right? So there's interest in this. Now, of those 198,000 people, probably less than 5% trade options. But yes, you could have this sort of number for open interest, the same numbers for open interest, and have something be more or less liquid than this. So open interest is just it's a small, it's just another piece to the puzzle. But I would say before you start making, big money trades in something, that you mess with it with small trades and get a feel for where you can get in, where you can get out. Can you usually buy stuff mid-market? If you are trading like an Intel, then if you put a spread in mid-market, it's going to get filled right away. If you want to buy an Intel at the money call, right? I mean, we just opened, and these markets are still are pretty wide. 74 bid at 187. This will tighten up pretty quickly, but you can see already a bunch of stuff is traded. Now, I don't know if this volume is from yesterday, because it seems amazing that much stuff would have traded in the first 2 minutes. So I'm a little suspicious of this volume for today in Intel. But the point still remains that you can trade stuff mid-market pretty easily in this. And if you are new to options trading, when I'm buying or selling an option, I'm going to try to I'm never going to pay the offer or hit the bid. I'm going to try to trade stuff in the middle of the market. And preferably, I'm going to stay on the bid side when I'm trying to buy something and stay on the offer side when I'm trying to sell something. You can see the market's tightening up before our eyes as the day continues here. We're 2 minutes into the trading day. This was 74 bid at 190. Now it's up to 99 bid. The markets are tightening up as we watch here in the morning, and that's fairly typical. You can see we're down to only 9 cents wide on the 60 call here. You can notice that the rounded number strikes are going to have more open interest than the weirdo ones a lot of times. Like the 65 strike here has 10,000 open interest. The 60 strike has 1,000, but some of the other ones, like the 61 strike, has less open interest. Makes sense. Less people are going to trade the 61 option than the 60, right? Rounded numbers are more popular. But yeah, the reason I can say, well, the open interest is decent and this or that is just from actual trial and error and getting to know the product over time. I guess there's a long-winded answer to your question there, Christina. When is the best time to trade? You know, there's a lot of people who only trade like in the first 2 hours. So I would think that the first 2 hours may have the most liquidity of the day. Now, certainly people trade stuff on the close. People trade stuff on the close all the time, and people trade stuff all day. However, the first 2 hours generally is the most active period of the day. And there are some day traders who only trade during like the first 2 hours of the day. So I would say generally I would say like from 10 in the morning till 11, something like that. Even right after the open, I would wait for the first 5-10 minutes for stuff to get going. But I would say from like 9:40 or something in the morning through 10:40, that first hour once stuff has opened and just settled a little bit is probably the most liquid time. After that, people drift away slowly from the markets, it appears to me. So there you go. What's up, Al? Nice to see you. Yeah, I wouldn't, I understand people being afraid of these meme stocks, and it makes sense because who wants to buy a stock that was $2 or $4 a couple months ago? Now it's $150. It certainly has room to the downside, A, and B, when you look at it from someone shorting it, this thing has blown up a lot of shorts, right? So it wouldn't be surprise anybody if this popped to 300 someday, right? So it is scary business out there with these meme stocks, no doubt. So there you go. I'm going to leave it there for you. I appreciate everybody watching. The show is kicking into higher gear as we come out of kids' vacation next week, and I have a bunch of stuff planned for this summer. So we're going to have some fun. Thanks for sticking with me. Leave a like, leave a comment, become a member. Thanks for everything, and I'll see you next time.
You're watching Famous Days.